Welcome to this explainer. Okay, today we are unpacking something pretty incredible, the ancient secrets to modern financial freedom. We're drawing directly from the comprehensive guides of Nilson Invest to show you exactly how principles developed over 3 millennia ago can completely transform your wealth today. You know, everyone wants to invest, and we all want to see our money grow, but very few people realize that true wealth isn't born from just rushing headfirst into the market. It's actually born from preparation. To get us prepared, we've got a clear roadmap for today. We're going to cover ancient wisdom for modern wealth, the great investing illusion, building your financial foundation, understanding risks and protection, the modern investment arsenal, and finally, the rule of continuity. Let's dive right in.
All right, kicking things off with part 1, ancient wisdom for modern wealth.
So let's look at a fascinating timeline here, specifically Joseph of Egypt. He actually managed to turn a devastating, severe famine into this unprecedented opportunity for wealth. He followed a very specific sequence of strategic preparation. First, during 7 years of plenty, he accumulated a massive reserve. Then, when the severe famine hit what we might call the bad day, he didn't just survive. Because he had liquid reserves when literally everyone else's money ran out, he was able to trade those reserves for livestock and eventually for land. He acquired massive wealth and assets from folks who were just completely unprepared. You might be wondering, how exactly did he pull that off? Well, his core principle was what's called the rule of the fifth part. Basically, this required setting aside exactly 20% of all harvests before that bad day inevitably arrived. If we translate that to modern finance, it's the equivalent of saving a fixed, non-negotiable percentage of your monthly income to create a cushion while things are actually going well. Moving right along to part 2, the great investing illusion. Look, everybody, and I mean everybody, wants to fast forward to the fun part, where their money is just multiplying. But before we go chasing those shiny market returns, we really have to stop and ask a fundamental question. Are you truly prepared to invest? Because honestly, jumping into the market without organizing your finances first is incredibly dangerous.
The source material from Nilson Invest hits the nail on the head here. They warn that trying to invest your money while you're drowning in expensive debt, well, it's exactly like building a house with absolutely zero foundation. If you've got credit card debt or a high-interest loan hanging over your head, it's mathematically highly unlikely that any standard investment is going to earn you more than what you're losing to the bank. Spoiler alert, there is simply no way to outinvest a 15% monthly credit card interest rate. You absolutely cannot outinvest bad debt.
Which brings us to part 3, building your financial foundation.
So how do we actually build that unbreakable foundation? So when we do invest, our wealth actually stays ours. Nilson Invest breaks this down into 3 mandatory steps you've got to complete before buying your very first stock or bond. Step 1. Get your finances organized and budget meticulously. Step 2. Ruthlessly eliminate all high-interest debt. Clear out those credit cards. And step 3. Build your emergency shield. You absolutely need a cash reserve, because if a crisis hits, say a job loss or a health emergency, and you don't have cash, you'll be forced to sell off your investments at a major loss just to survive. Think of your emergency fund as your ultimate insurance policy against debt slavery. But how big should this shield actually be? Well, it needs to be heavily customized based on how stable your employment is. The sources suggest that stable professionals should aim to have about 6 months of expenses safely tucked away. But if you're a freelancer or you're dealing with a variable income, you need a much thicker shield. You should be aiming for up to 24 months of living expenses saved up.
All right, next up is part 4, understanding risks and protection.
A lot of beginners kind of fall into this trap of thinking all investments are 100% safe. They definitely aren't. But in Brazil, there is a very specific safety net in place called the Fundo Garantidor de Créditos, or FGC for short. This system actually protects your money in specific financial products up to 250,000 reais per individual per financial institution. That is a critical detail that savvy investors use to their advantage. There's also a global limit to this protection, which caps at 1 million reais every 4 years. Knowing these numbers gives you the exact parameters of your safety zone.
Now, alongside that protection, we also have to talk about the tax bite, because not all investments are taxed the same way. We're going to define these acronyms in just a second, but just know that products like CDBs and Tesouro Directo are taxed on a regressive scale, meaning the longer you leave the money parked there, the less tax you actually pay. On the flip side, products like LCIs and LCAs generally offer complete tax exemptions for individuals, which makes their net returns highly attractive.
Okay, let's get to the really fun stuff. Part 5, the modern investment arsenal. Now that we're protected, completely out of debt, and we understand our safety nets and our taxes,
Let's crack open that investment arsenal. First up is Tesoro Directo. When you buy these, you're essentially lending your money securely to the federal government. And since a country's government is generally the safest debtor out there, these bonds are widely considered to be among the most conservative and secure investments available in Brazil.
Next up in the arsenal, we have CDBs. So instead of lending to the government, here you're lending your money directly to banks in exchange for a set return. And the really great thing here is that you typically get to enjoy that FDIC protection we just talked about, making it a super solid option for conservative growth. Then we've got LCI and LCA. And these are fascinating because they're credit instruments backed specifically by the real estate and farming sectors. Because the government actively wants to stimulate these critical industries, these are the investments that frequently offer those sweet, complete, tax-exempt returns we mentioned earlier. Now, for anyone out there wanting a steady stream of monthly cash flow, and who doesn't, right? FIIs or real estate funds are an absolute game changer. They allow you to pool your money with other investors to buy into major real estate projects, like massive shopping malls or premium office towers. You get to passively collect a share of the monthly rent without ever having to buy or manage a whole physical building yourself. You just skip all the headaches.
Finally, we have ações, or stocks. This is where you actually buy a slice of a publicly traded company. You literally become a partner in their business. While this brings a much higher potential for growth and dividends over time, it definitely introduces greater volatility. The market swings wildly, which, if you think about it, is exactly why you needed that emergency fund foundation we built earlier.
Bringing it all together with Part 6, the rule of continuity. To actually execute this long-term strategy, the source material draws a pretty brilliant parallel with the concepts found in the book Atomic Habits. It's this reminder that true wealth isn't a sprint, it's a very careful construction. Financial education is not just some one-time event where you read a single book and you're magically done. The absolute most powerful habit of a successful investor is an unwavering commitment to learning continuously. As the Nilson Invest methodology perfectly summarizes, your very first investment must absolutely always be in your own understanding. The market heavily rewards knowledge, but it severely punishes impulsive decisions driven by a lack of education. So, having walked through this entire strategy together, from 3,000-year-old crisis management all the way to modern financial tools, I want to leave you with this thought. Take a hard, really honest look at your finances today and ask yourself, is your foundation truly strong enough to support your future wealth? Get yourself organized, build that reserve, and educate yourself. Because only then can you safely dive into advanced strategies. Thanks for joining me on this explainer. Now go build that foundation.